Awesome. Welcome, everyone. Thank you for showing up. And we're going to be going over order blocks and fair value gaps were the top two requested. And then after that, we're just going to get into a little bit of brokers for TradingView, breakers, and algo theory. So, order blocks. What I want to start with, this new dang TradingView deal, I don't know how to, does anyone have the new zoom and know how to change the color on the drawing deal? Let me see. They used to let you change it here, but no, I don't. Okay. We'll just go with black. So if we have a bullish order block, start with basics, it's going to be, so I wish I had color. This is going to be a red candle. So it's going to be the lowest down closing candle in a range. So say we're looking between this high and this low. We want to see which down closing candle has the lowest close. So between this high and this low, the order block is going to be right here. Because this is the candle that has the lowest close. So the order block is always going to be placed at the wick. That's where it begins. Now, as you go through your trading, you'll start to realize that it is a little bit of a, I would say, a safer bet placing it at the order block itself, because price sometimes does just come right into the wick of that order block and leave. But I would say more often than not, you're definitely going to catch some heat, at least into the order block. And we pay attention to that mean threshold, which is 50% of that order block. So as you're coming into this level, there's like these barriers that it runs into algorithmically, right? So this is the last down closing candle in price right here. So we know, right, we wouldn't really want to place a buy order here. We'd rather place a buy order here, right? It could be the difference between 8-to-1 and a 10-to-1, just as an example. So a bearish order block is going to be the exact same thing, but on the opposite side, right? So the very last candle with the highest up close, that's going to be your bearish order block. So remember, this is really, it's just a fancy way of looking at support and resistance. That's all it is. The highest, think of it, it's just a zone. The lowest, it's a zone. If price trades outside of it, there's a good chance that it goes back to that zone and bounces off. And vice versa. If it trades outside of this order block, there's a good chance that it comes back into it and trades away. It's just the highest zone in that range. So the bearish order block would be right here. That's the highest close in that range. So where would we sell it at? We wouldn't necessarily sell it, or, well, this one doesn't really have a wick on it. So we would just set it at the low, right there. So say that we were entering on this order block.
So a bearish order block is just a zone. That's what you just said?
Yes. It's just looking at it like a specific zone. So like, again, we're using this range right here. Probably would have been smarter to do from the start. But we're using this range here from that high to this low. So when we're looking at that range, we're just looking, we're looking down until we see a close. There's a close. So if this is the high of the range, this is our bearish order block. And again, yeah, it's just a zone. Look, right there. That's how we would draw it out. A little bit lower.
So it's like a double top, double bottom type shit, or is that like?
No, not necessarily. Like, for example, we'd have to look at all the confluence on this trade, but you'd be thinking something like this if you're entering on that order block. maybe trade down toward this gap or something, right? But what I kind of want to draw your attention to is you see how it trades up and creates that high,
Yeah.
right? I want you to think about, because this range wasn't here yet. Think about the range that we had. You see that break-in structure right there?
Mm-hmm.
So we trade up, make a high, we break structure, and then it pulls back into that zone. That's just a break and retest, right?
Right.
So it's the same thing, but we're just looking at that specific level. So when it trades up into that order block, same thing I showed over here. You would go short at the order block, put your stop at the high of it, and then your take profit. This level was already broke. So we aim for the next one. I'm looking at this level right here. Right,
For
and
sure.
that's our 3-to-1. We can start taking profits there. Then our stop goes to break even, and we have a runner.
Bet.
So that is how we want to look at our order blocks. Now, you have to have some understanding of where price is likely to go and why. So for example, like waiting on breaks in structure. Because at the same time, say that we're looking between this high and this low, this now becomes our bullish order block. You see that? So if it trades into it right here and you buy that, your trade gets stopped out pretty quick. So that's going to be the trick, is you want to wait for that structure break. You see how right here, we really have nothing. It was just a flat trading range. There's no structure in here. And once it trades back up into it, it drops.
Okay, cool. So Pete, what cause I'm in GJ right now, right?
Mm-hmm.
So GJ 15 minute. Is
Mm-hmm.
there is I have an order block placed like right here if you can see it. Is that an order block? Is that a correct order block?
You'd have to drop it in the chat,
Oh, you can, okay.
and then I'll
So
just let you know.
Answer me this, Tyler. It's order block score go at higher time frames.
What do you mean?
Uh, how he just said he was using the 15 minute. Is it just as strong as that 15 minute as the 4 hour?
No, I was the higher you go, the more strength they're going to have.
Here we go. That's what I was. Okay.
Right, and so we want to think like they call it fractal, right? It's just something. It's one thing inside of another, right? So like I think of Mr. Potato Head. Like, say you find a 4-hour order block here. Now, when you go short in here, you would just go down to your 15-minute, right? This is your 4-hour. This is your 15-minute. You would just go down into your 15-minute and find another order block in there to trade.
So are you able to back test that? And we can see that right there.
Yeah. So right there was the order block. Here. So it trades down as a good measurement. If you measure your order block, because this is where you're expecting your stop to be, and this is where you're expecting your entry to be. Let me turn these off real quick. So you're expecting something like this to form off that order block. So what I always look for as like a really good bonus, if it's gone at least one deviation down, then it's probably at least a pretty solid order block to look at. Now you can see right here, it trades up into it. That looks like the end of the day right here, 2,300. And then right here, we go into a new day, 1 o'clock in the morning, 2 o'clock in the morning. Right here, 3 o'clock, we're prime time London session.
Uh-huh.
Now right there, as soon as it trades below that candle, and you could set it like 50% of that order block, like that mean threshold. And then you'd either look for this most recent low.
Right.
Or, whoops, or the low before that one. Should be here. And you can see it runs 6.5.
Mm-hmm.
But that would just be a quick example on how you would like break it down, you know. And the key is being patient and waiting for that setup, because if you're only sticking to, for example, like 4-hour order blocks, you're not going to take as many trades. You're not going to have as many trade signals, which is a good thing, right? You're going to have more probability on your side, but it's going to require a little bit more patience using that 4-hour chart. So what makes a high probability order block? There's probably a handful of you in here who know, but a high probability order block is followed by a fair value gap. So a fair value gap, I want you to think about like this. So in the Forex course, it's going to be dropping. It's going to be covering fair value gaps, but I'll give you this drill a little bit early, unless you've been through the course already. So to have a fair value gap, if you're taking notes, this is important. To have a fair value gap, you have to have at least 3 candles. It's a minimum requirement. Any fair value gap has at least 3 candles. So what we do is we look at the bodies, right? And then we see, we want to look for space. So then we move to the wicks, and if the wicks are not crossing, so for example, we drew a straight line at that wick, and we drew a straight line at this wick. You see how there's no wick in here, there's just body, meaning the body of that candle. Right, so this here is our fair value gap. And so why is price doing that? Because price is being pushed down so fast that they can't push it up. It's only moving down. There were no buyers right here, just gap down almost. Right? This is like a trick question. And the theory is like, why do you think that? Well, because these wicks, are these wicks bullish or bearish? It's a trick question, right? Because the wick had to, if it's a wick, it means it traded up and then it traded back down. So a wick can't really be bullish or bearish. It's both every time. Right here, it traded down, then it traded back up. Right? That's just the nature of wicks. So if there's no wick, what does it mean? It means it only traded down. So that was essentially what a fair value gap is. It's the area where it only traded down, where there was no wick. We're just focusing on that open body of that candle right there. And then we can look for example, a retracement and trade away. Now, what we want to do is we want to pair fair value gaps with order blocks. So say this was the highest closed candle right here. This is up close. Sorry, I don't know how to do color yet with the new Zoom update. Say this is a bullish or a bearish order block, excuse me. So a bearish order block is what color candle? Green, right? A bearish order block is actually a bullish candle. So this is the last up closed candle. So if we have this fair value gap, we want to, excuse me, why did delete one? There we go. So if we have this fair value gap, what we want to do is we want to pair it with the order block. So we trade the order block and the fair value gap. Does that make sense? So why would this order block be a valid trade? So I want you to count the candles. 1, 2, 3. So there's no space in here. There's nowhere we could draw just a flat area with just these 3 candles. So then this candle comes along. We use the previous 3 candles. 1, 2, 3. Same thing. All this area is covered. You see it wicks up, trades up, but then what does the next candle do? Wick back down. Then we get this candle. Trades down. 1, 2, 3. We still don't have enough information because there hasn't been a third candle to confirm it yet. Then we move to this candle. Now, looking back, 1, 2, 3. See, there's a gap between the low of the first candle and the high of the third candle. So we would draw our fair value gap out like this. Again, it's the low of that first candle in the bearish sense, and the high of that third candle. And so once that is created, again, that was created where on this candle. Do we look at the fair value gap? No, not for how we want to set this up. Where do we look? We look right here at the order block. Right, so this would be our entry. And then right here at the top of the order block would be our stop. So our setup, again, would look like this. And we'd look for at least that new low to be broken. So you see that trade. Now, same thing on the other side. This one's a little harder to see. Let's go with this one. So right here, we can see a high probability order block. Why is this a high probability order block? So right here, between this candle and this candle, we had a fair value gap. Now, sometimes it'll just trade to the fair value gap, but for what we want to do, again, we don't look at the fair value gap. Again, first candle, second candle, third candle. The high of this first candle, and then the low of the third candle. It just flips. But we don't keep our eyes just on the fair value gap. What I want to look at is the order block. And again, like I mentioned at the beginning of the video, you can enter here, but say you entered here with your stop at the low of the order block and you were searching for a profit at the previous order block that traded. That'd be a 1 to 9. But if you put your entry at the, or 1.9, excuse me. If you put your entry here at the body of the order block, it turns it into, you go from a 1.9 to a 2.8, almost an entire extra trade in there. Just from moving your entry from here to here. So it is pretty powerful. You know, and sometimes you do miss trades. That's the downside of it. Sometimes you are going to miss part of those trades. So, does anyone have any questions about order blocks or fair value gaps? Is there anything I can help you with that?
Is there any way you could check the chat? Because I sent it in there. I just want to make sure, see if I'm correct.
Oh, sorry, man. Oh, you sent it to the Discord chat?
Yeah, in the general chat.
Oh, okay.
This little box I have right here. It's like a double bottom.
The down closed candle would be your order block because it eventually gave a fair value gap. But I wouldn't use that as a high probability order block.
Nah, but it would be like a order block, right? Or no?
It's in, yes. I mean, that's where
Kinda.
yeah, because anything can be an order block, right? It's more important about the range that you're looking at because you could keep breaking them down. But like I said, the difference maker, or kind of what helps with the high probability factor and getting you in, I guess, faster, cleaner trades as far as your entry and your stop, are when they
Hmm.
come with that fair value gap. And obviously, it's not always, but when you pair it with different strategies, or not strategies, but different confluences is what I meant to say, then it kind of, the gears turn a lot better.
Okay.
Cool. So brokers for TradingView Mac, I would say Awanda and Interactive Brokers. Those would probably, I'm not affiliated with them, but those would probably be the best because they're regulated, but it's up to you who you choose. Right? There's definitely plenty out there. But you really, you can't go wrong with this. Other than a couple, the rules and regulations are definitely a little different. You'll have to research them, but it's essentially the same experience. What's up, Clayton? You got any questions about trading, Clayton? Let's see. So breakers. Let's cover breakers. So it really works out because the system that I teach in the free academy has 3 steps. Well, really, there's a pre-step, but so the first thing you need to do, just in general, is find a higher time frame level. Right? I don't care if it's a daily, weekly, or monthly level. But I would say pick one of those. Now, if you have a higher time frame, daily, weekly, or monthly level, then this is your entry model. And the entry model is 3 steps. You have your breaker, you have your order block, and you have your fair value gap. And you can't have a high probability order block without a fair value gap. So kind of all work together. Also, the breaker only strengthens this. Plus, being at a daily, weekly, or monthly level is going to help. So first, I wish they had dividers here. Let's see where Monday is. Okay, here was that Sunday. So that was 2 weeks ago. Okay, so I don't want to use that same setup. Let's go with this one here. So a breaker is, obviously for order block, we're looking at ranges. But a breaker, you want to set up market structure. So you want market structure to be favorable. Now, first you have to start with a higher low. I'll just go with a bearish example first. And then once it trades up, you break that high, right? That's why it's called a breaker. So you break the high, and what you're waiting for, what's going on there? Why is that significant? Retail and breakout traders will begin to chase that high. So now there's liquidity involved in the trade. So you want to wait for price to break down in structure. Like I said, that's why it's called a breaker. breaks up, then breaks down. So why would this be significant? Well, this was a low that was made in price. So now retail and breakout traders are trading, right? This is the dynamic of every trade setup. Get people on both sides and then take the losers out, right? That's just the nature of how trading works. That's why it can work, because they get one side that gets too heavy and then they take their money, right? So once it breaks that structure and you have those liquidity triggers, you wait for a pullback. You want to find an order block with a fair value gap favorably, and then you want to see it trade up into it and then trade back away. So essentially, you're looking for a breaker, you're measuring this leg with a fib. That's it. So let's talk about just a simple setup. So like right here, you can see it traded above that high. That was Tuesday's high. So it traded above Tuesday's high and then broke down. Now, where would our order block be? Right here. Now it's high probability. So one of the rules with order blocks is if that same color candle is connected to it, technically those are all part of the order block. So for example, you can see this, I just had this level highlighted on the 4 hour, but if we go to the daily, right, you see how that all of this is a daily order block here. So now let me go back to the 4 hour. Right, you see how all of this is an order block? So for this example, and for any time in the future really, when you see these order blocks like this, they can be a little more difficult. If you see a bunch of them, like right here, there's like 7 or 8 candles, I always go up a time frame and just mark it like that, because sometimes it'll be a little different. Sometimes you'll just get something that looks like this or something like here, or right. So I always would just say go to the daily, go up one time frame and mark it there. So we take out Tuesday's high and we formed an order block. Now, is this order block high probability? Well, it kind of gets into question because we have fair value gaps, but if we're using this entire order block, is that daily order block high probability? I would say no. There's no, it is after the fact right here when you get that gap. So this would not necessarily be a high probability order block on the daily, but you do have some confluence there, at least on the 4 hour. So break structure to the downside. Not quite that low. We did break this one at least. So it breaks up. What's retail doing there? Chasing. Same thing, it breaks structure. What does retail start to do? Chase. So now you have liquidity on both sides. You have the buyers above this high and the sellers below this high. Now what do they do? They just pull back up into that trade. So again, it's essentially just a retracement. If before we go over all the technicals, just think about it like that. You want to see a high and a low, right? Even if you don't use order blocks, even if you don't use fair value gaps, just use this market structure at least. This will make your trades a lot higher probability. So it trades up through the high, breaks to the high, trades down through the low, breaking through the low. We measure that. It pulls back. We're looking for our trade now because it's taken out the high and it's taken out the low. So we're looking for our trade. Trades back up into 50%. That just goes back into premium and discount. So we want to sell at least 50%. Say you were just using that daily frame, it would look like this. You would need to look, at least look for 1-to-1. That probably wouldn't be the best frame to use. Or you could end up using something like an old order block here. Because this order block, you see this order block here? It had a fair value gap. It's kind of hard to see. Make that a little larger. So this order block here, and this happens in trading, you see how it has a fair value gap. And again, this would not be the order block. We'd use this one because it's the highest up close candle in the range between the high and the low. So we got that fair value gap. So right here would be our order block. So if you get stopped out on this one, really what's your risk? Not much, right? And even if you're taking profit here, you're still getting a 5-to-1. Now, you get stopped out, place another sell stop right there. When it trades into it, it puts you in that trade. You had 5-to-1, so it's really or it's really about 6-to-1, so you really just got a 5-to-1 if you got stopped out once. Right, you don't have to you also don't have to enter blindly like that. You could look at price and time. Right there's 1400. That's 2 o'clock New York. You would just go into that 15-minute and scalp that high of the day. For example, let's put back just a hair. This is what we look like on the 15-minute. So that first one, what we got taken out, there's 830. This is bond open. So it runs above it. And then what does it give? It makes what looks like Wednesday's high of the day at 1 o'clock. And then what do we get again? Takes a high, takes a low. There's our breaker. So we measure the leg. Pulls back to 50%. We're looking, right there's a fair value gap. So where can we sell? Right there at the order block. We put our entry at the body. We put our stop at the top of the body. And we could even just hop on the same TP that the 4-hour tried to put us on. 25 risk to reward, 25-to-1. Now, if that taps you out with spread, just re-enter. Right, especially scalping, but that's not, look at the stop. And if you're okay with taking a larger stop, just put it above the high. Then you're going down right about 10-to-1. But that is really how you break it down to get those good entries. Let's see. So when you can combine the three, a breaker with an order block that has high probability because it was in a fair value gap, you can really start getting some good trades behind that. Cool. So next topic was algorithmic theory, I believe. So algorithmic theory is really just quarters theory. Algorithmic theory is essentially quarters theory. It's the importance of these levels. So algorithmic theory, for example, if we build in a market maker buy model, I know not everyone's familiar with a market maker buy model, but it essentially has a consolidation, 3 pushes up, stop hunt, and then 3 pushes down. Now, these algorithmic levels typically act as support and resistance for trades. Now, the way that we use this is looking at IPTA, right? That's how I use it, looking at the last 20 days. We'll start there, 20, 40, and 60 days. So let's just start with 20. And so TradingView has this cool measurement tool. So you just go over here. Sorry, I'm not that familiar with TradingView. So right here, date range, we put it on the first day, and then we'll go back minus 20 bars right there. So you can see there's 20 days of price action right there. Now what we're going to do, so we'll just break that down to the 4 hour. We're going to measure that range. Again, it's the last 20 days. And now we're on the 4 hour, so it's 120 bars, right? And it's saying 28 days because that's including the weekend. Now, we measure, put my magnet on, from the high all the way to the low. And then we'll push it out. So, not always perfect, but this is how we begin to look for market maker models. So, we wouldn't know this low was there until right here. We wouldn't know that that low was a significant low. But once it made that low, then, right, that day right there, we know that we can start looking for possible high probability setups. Especially if that low, remember we can use the power of looking to the left. Can't use a white line though. If there's something significant there. So let's go to daily. There is, right? It traded into what? You can see it traded into an order block. So could that hold? Well, I don't know. Is it high probability? Yes. How do I know it's high probability? Because it has a fair value gap. So because that low was significant, I can put emphasis on what? This order block here. Why would I put emphasis on that order block there? Because it has a fair value gap. Right now, you can see now that that low was made, we drag the high and the low, and even after the fact, you can see they were respecting these levels. Look right here, turned. Now, for example, algo theory is fractal. The same thing is we look for a breaker on the 4 hour, and then inside of that, we look for a breaker on the 15-minute. Right, we're looking for the same thing, just on different time frames. We're looking for confirmation that price is taking out buyers and sellers, and then wanting to come back and move lower. So what we can do with some of these levels, because you see like here, if you want to get real geeky with it, you want to see every turn. You're like, what the heck is going on? I see this turn here, but why isn't it at that level? I see this turn here, but why isn't it here? Because price is fractal. So these levels we can cut up. So now you can see a little bit more of what actually happened. See how they set the highs right there? Why did they leave those highs? Where did they leave them? They left those highs right at 50%. But did they get to 50%? No. But then they'd come back, smack. They trade down. Where do they trade to? Below this low. Well, what's below that low? We cut the level. What do you know? Look, they traded down to 75% because we're cutting it into fourths. But look, they don't reach 50. Same as right there. And then what happens? Got smacked. And then we run down further. And we go down and we create the low. Again, we can cut all these levels up too. Now this one, see it pulled up, but what did it fall short of? It fell just short of the 50% from the last 20 days. So there's probably liquidity there, I would guess. Now again, we can do the same thing on all these levels. So for example, say we cut them here. Now I'm just showing the algorithmic principles of it because we wouldn't be able to use these on the downside because we would not know that this low was there yet. But if they have respect, right? Again, we had that line right here. If they have respect on this side and this side looks good, and you see signatures like this, you see signatures like this, then you know you probably have a pretty good market maker model on your hands. Look, that high probability breaker order block fair value gap we went over, where did it happen? Right there at 50% of this level, premium setup, high probability, right? It all overlaps. That's confluence. So if we can't use it, how does this help us? Well, we can use it, but we need to use it on the other side. So we set the low right here, and now we're looking to buy these algorithmic levels. We look on the lower time frames. You don't even understand what I'm giving you right now. We look on the lower time frames for movement around these levels. So now as we're bullish, let's just look at it and see what trading opportunities you might have found if you'd had this tool. So it makes the low. We'll take out the order block. So you have 25, 50, 75, flat. So you see it trades all the way down to the 25, but does not take out the low. Now, is this order block right here high probability? Yes. Why? Because it has a fair value thing. Where's the order block located at? 50% of that lower low. So these lines aren't absolutely perfect. So there's a pretty strong order block right there. So you can see traded into that 50, bounced around. But why do I like this order block? Because it's high probability. Why is it high probability? It's at a fair value gap. So it trades to that 50%. Now, if we're just looking at a traditional order block, guess what? Unfortunately, this one would have gotten stopped out. But it's right there at the 50. So we could have just re-entered or bought that stop. Do you see what I'm saying? Traded to the low of the day and hit that 50, and then on a dime at a higher probability order block, breaker order block, fair value gap. How do I know it's a breaker? It took the lows. It took the highs. There's a fair value gap right here. Now, say you went and you took it down to a lower time frame. Right there, same thing. sets a level, breaks it, pulls back. We didn't get the full breaker order block fair value gap in here. This one would be high probability because you have that small gap here. But there wouldn't really be anything on the 5 to use in there. They really just went and got up out of there. There's always something on the 1 which can be a problem because it'll give you any setup, like if as long, and that's kind of the point of the system is as long as your higher time frame is on point, like right here's that 50, then we can just use that. So it goes right here, we create that small fair value gap. So this order block is high probability. I have it at least a little bit of confidence because of the higher time frame level there. Creates that fair value gap. Another one trades back into it. Again, a traditional just entry, you would have got stopped out once. But what's your risk versus your reward on this one? Your entry's at the top of the order block. Let's just say you take profit at literally at the top of your higher time frame order block. That's just a 10 to 1 getting to it. Now say you set it below the low, you might not even get tapped on that one. It's about a 6.5 to 1, but that's the difference. You're taking a 6 to 1 versus an 11. Now, as it breaks out, of the order block, right? You don't have to take profit there. You'd be aiming probably for the high of the day or high of the week. 20 to 1. I'm telling you, this is all, this Zoom right here. If you just studied this and you were patient and you focused on these levels, you'll make it where you need to be. But the key is doing the same thing over and over. I hope to cover that in a future video where we'll break down a system. I'll use one of my simple systems. I'll just give it to you guys and we'll break it down and I'll show you how you can use it along with this stuff. But this is all you need right here. I showed you how the levels work. I showed you high probabilities as far as entries, as far as breaking down time frames, which I know is a lot. So this was recorded. I will post it probably tomorrow. But thank you guys for being on the call. Is there any last minute questions?
No, I appreciate you, bro. It's just gonna help out a lot.
Yes, sir. I got you.
Yeah, appreciate the Zoom, Tyler, man.
Yes, sir. No problem. Good to see you. Cool. All right. Well, I'll see y'all in the morning, and then I'll have probably another lesson planned out for tomorrow, depending. But yeah, we'll probably end up doing something tomorrow too.
Hey, Tyler.
Yo,
Hey, so I guess in this 30 trade, so what? Just it'll go to 34 and then 34,500.
you do have
buying
to.
up.
Well, the key is right because this thing could turn and start headed down. The key is to look for those high probability setups in those directions at those levels.
All right, bet.
Like
Okay.
this is definitely adding a level of higher confluence to it, but the breaker order block fair value gap is all you need. This will just help you. Everyone wants more trades, and this is the way to get more trades and still stay accurate, you know?
Yeah. I bet. Appreciate it.
Yep. And you know, I know that this stuff is probably just like a lot at first to like work through. So just go on your own and just start trying to mark it up on your own charts. And then I'll post that YouTube video and then just watch, like scroll to this part again, just watch this part or whatever parts you need, you know, and practice them. and then go do your chart and try to make it try to line it up with what I'm showing you. Cool.
All right, bet. Appreciate it, bro.
Yes, sir. Let's see what AI Companion says. Oh, dang, I didn't turn the AI Companion on until just now. But all right, y'all. Appreciate you being on. Like I said, let me know if you have any other questions. Any last minute questions? Anything you guys want to cover again? Order blocks, fair value gaps?
Quick question.
Yep.
Did you show how to set those levels that you have?
Yes.
Oh, you did? Okay.
So as far as on the fib, or are you just saying
Yes.
like here?
On
Oh,
the fifth, yes.
okay. No, I didn't. So here on the fib, go to settings and then go to style. And then you can, so I have like some of them toggled, like you can set a bunch and turn some off and some on, but I just have mine at, it's basically just quarters. So it's at 0.25, 0.5, and 0.75.
Okay, thank you.
No problem. I'll leave it right here. So you're just cutting them into fourths. That's algorithmic theory. Because, and it's like, if you look at the background, you know, it really gives it away too. Like price is just, right? So if you go to your fibs, there's fibs for up and down measuring price, but there's also time-based fibs, right? So essentially everything is like a grid, right? And that's kind of what the algorithm is seeing, right? Is that they have all these little levels and pings that they're kind of, each piece is connected. They're all feeding data into each other. As far as these, you know, not smaller companies, but these billion-dollar companies that, you know, they're breaking the market down to its atoms essentially. But all right, y'all. That's gonna be it. Y'all have a great night, and I'll talk to you soon. Peace.